What if the real decisions, the actual prices of the assets you hold, have already been determined long before you ever click buy or sell? What if what you're watching every day isn't true price discovery at all, but a carefully managed illusion designed to keep emotions high and understanding low? That idea might sound uncomfortable, but discomfort is often where the truth starts to show itself. Most people open a chart, see green candles, see red candles, and assume that's the market thinking in real time. But markets don't think the way people do. They react to systems, incentives, liquidity, and structure. What you see on the screen is the final output, not the decision-making process itself, and that distinction matters more than most people realize. Before we go any further, take a second and hit the like button if you appreciate calm, clear conversations about markets without hype or fear. And if you want more content that focuses on understanding instead of panic, make sure you subscribe. It helps the channel and it keeps these conversations going. Now let's slow this down and really talk about what's happening under the surface. Price movement feels chaotic because it's designed to feel that way. Volatility grabs attention. Emotion creates engagement. Engagement keeps people watching, trading, reacting. But the largest players in the market don't operate on emotion. They operate on probabilities, risk models, time horizons, and liquidity needs. Retail traders often believe they're competing against other individuals. In reality, they're participating in an ecosystem dominated by institutions, algorithms, and capital flows that operate on completely different timelines. That doesn't mean the system is evil or rigged in a dramatic way. It means it's structured for scale, not fairness. When people talk about price discovery, they imagine millions of independent decisions forming a fair value. In practice, price is heavily influenced by where liquidity exists, where stops are placed, and where incentives align. Markets move toward liquidity because liquidity is where transactions can happen efficiently. That's why price often moves in ways that feel illogical. It's not reacting to news the way humans expect. It's reacting to positioning. When too many people lean in one direction, price often moves the other way, not to punish, but to rebalance. This applies to stocks, crypto, commodities, everything, and it especially applies to assets like XRP, where emotion, narrative, and regulation intersect in very public ways. XRP sits in a unique position because it's not just a speculative asset, it's tied to a real conversation about financial infrastructure. That alone changes how it behaves, compared to assets driven purely by hype cycles. One of the biggest misunderstandings in crypto is the belief that price leads adoption. In reality, adoption usually comes first, quietly, slowly, often unnoticed. Price reacts later, sometimes much later. By the time price moves dramatically, much of the groundwork is already done. This is where patience becomes a strategic advantage. Not blind faith, not emotional attachment. Patience based on understanding. Knowing what an asset is designed to do gives you context when price doesn't behave the way social media says it should. Markets also don't reward certainty. They reward flexibility. People who believe they know exactly what will happen next often take the most risk. People who accept uncertainty tend to manage risk better. That's why responsible conversations avoid guarantees. No one knows what tomorrow brings. Anyone who claims certainty is either guessing or selling confidence. What we can do is observe structure. We can look at incentives. We can understand how systems behave over time. Financial markets are built to transfer wealth from impatience to patience. That's not a slogan. It's a pattern repeated across decades. Volatility is not a signal by itself. It's a tool. It shakes weak hands, tests conviction, and redistributes positions. Large players expect volatility. They plan for it. Retail traders often react to it. This difference in behavior explains a lot of frustration people feel when markets don't move logically. Logic depends on perspective. What feels chaotic from one angle can be extremely efficient from another. XRP's long history of scrutiny has forced it into a slower, more deliberate evolution. While other projects sprinted ahead on hype, XRP had to navigate regulation, legal debate, and institutional expectations. That process isn't exciting, but it builds resilience. In the United States especially, regulatory clarity shapes behavior. Institutions don't chase trends. They wait for frameworks. They wait for risk to be defined. That waiting period often looks like stagnation to outsiders, but stagnation and preparation can look identical on a chart. Another important point is time preference. Most retail participants think in days or weeks. Institutions think in years. When those two timelines interact, confusion is inevitable. This doesn't mean retail participants are wrong to care about price. Price matters, but price without context leads to emotional decision making. Understanding structure doesn't mean predicting outcomes. It means reducing surprise. And surprise is what causes most losses. The idea that markets are purely fair or purely manipulated misses the truth. They are structured systems with incentives. Those incentives don't care about individual outcomes. They care about flow. Once you accept that, the emotional charge around price movement begins to fade. You stop asking, why is this happening to me? And start asking, what behavior does this structure encourage? That shift in thinking is powerful. If you're still with me, make sure you're subscribed. Content like this doesn't chase trends, it explains them. The biggest mistake people make is assuming tomorrow defines success or failure. In reality, long-term positioning is built during boring periods, not exciting ones. XRP's relevance isn't tied to daily candles. It's tied to whether the problem it was designed to address still exists, and global payment inefficiency absolutely still exists. Technology adoption rarely follows a straight line. It stalls, accelerates, pauses, and surprises. Charts don't capture that process well. What they capture is emotion. Emotion is easy to monetize. Understanding is not. That's why calm analysis often feels less exciting than bold predictions. But excitement fades. Structure remains. Whatever happens next, whether markets react strongly or barely move at all, the underlying system keeps operating. Payment rails don't stop because price pauses. Infrastructure doesn't disappear because sentiment shifts. Tomorrow is just one frame in a much longer film. If you're watching markets every day, remember this. Your biggest advantage is not speed, leverage, or prediction. It's perspective. Stay informed, stay patient, stay aware of your own emotions. And never confuse noise with signal. If this kind of content helps you think more clearly about markets, hit the like button. It tells the algorithm this conversation matters. And subscribe if you want more grounded discussions without hype, fear, or false promises. Because in a space full of loud voices, clarity is the real edge. And clarity is what lasts. And clarity becomes even more important when you realize how much modern market behavior is driven by automation. Algorithms don't feel fear. They don't feel excitement. And they don't read headlines the way people do. They react to data, order flow, volatility thresholds, and liquidity conditions. When price moves suddenly, it's often not because of a single piece of news, but because multiple systems reached a trigger point at the same time. This is where many people get frustrated. They read an article, watch a video, or hear a rumor, and expect price to react in a simple, logical way. But markets don't work on single narratives. They work on overlapping forces. Sometimes news matters a lot. Sometimes it barely matters at all. The difference is timing and positioning. For assets like XRP, this becomes even more complex because the conversation isn't just about speculation. It's about infrastructure, regulation, and long-term use cases. That creates a disconnect between short-term price expectations and long-term development. A lot of people underestimate how slowly financial systems change. Banks, payment networks, and regulators don't move at the speed of social media. They move through committees, testing phases, pilot programs, and risk assessments. Progress happens quietly and often invisibly until it suddenly becomes public. That's why patience is so difficult in this space. You're watching something that evolves on a multi-year timeline, but you're measuring it with tools designed for minute-by-minute movement. That mismatch creates stress, doubt, and emotional decision-making.